All right, welcome everybody to this wonderful Tuesday evening right here in Bangsa South at the CFA office at Common Ground, right? And so today's very, very interesting session, yeah. But before we go into that, let me just introduce myself. My name is Farid Rizwan. I'm the Vice President of the CFA Society Malaysia. And today, the session that we're going to talk about is active versus passive management. So, there's a lot of fear nowadays on whether money is going to go all the way to passive, and whether active managers are a product of ancient times. Yeah? So that is the exact question that we're going to answer today. Yeah, but before I go into that, let me introduce the esteemed panelists with me, and maybe we'll start off with the gentleman to my left.
Okay, my name is Amiruddin Abdul Hamid. I've been in the industry since 2002. I've been in 5 companies already. I started as active fund managers. Then last year, in March 2019, I started to join a Robo Advisor company. So it's kind of still active fund manager, but it's used a lot more quantitative compared to my previous fasa. Totally new thing for me, totally new trend that we see more in the future. So I will discuss more about my expertise about Robo-Advisor. That's all for a brief overview about myself.
Thank you, Ami. And on to Kamal.
Good evening, everyone. So my name is Kamal Mustaza. I'm from Delhi Finance. So I mean, in terms of my professional background, I started my work in PNB, and then after that, I moved around quite a bit, and finally, I ended up in Delhi Finance. In terms of my academic qualification, I managed to survive my uni years. In 2011, and then after that, I started to pursue my professional papers in CFA, CIA, FRM, and CPIM. So that's all. Yeah.
Thank you, Kamal. And then on to our last panelist, Chua.
Hello. Hi, I'm Chua. I'm actually a hedge fund manager from Singapore. I actually have this fund called TGCC M3 Momentum Fund. I was the co-founder of it, together with another 3 amazing gentlemen. So the fund strategy is actually, we are a macro fund serving accredited investor only. And playing futures contract, and we are program trading, and we are part of that algo execution trading system. Hope I can share more about my job scope later on.
Great. So together we have, with us today, we have a Robo-Advisor, an ETF provider, and a hedge fund manager. So I bet there's a lot of questions out there, and you can, the audience can also submit their questions via Member Pulse. Yeah, and the link to that is in the comments right here in this Facebook Live. So then let me just start off with a little overview on what asset management. What is asset management? Yeah? Be it active or passive, what is asset management? Asset management is it's really in the name. Yeah? So it's management of wealth through asset classes. Yeah? What are these asset classes? So it can range from commodities all the way to vanilla products like equities and bonds. Yeah, and there's so many different kinds of strategies in this kind of world. Yeah? But one thing is very, very clear is that there has been a gradual shift from just blindly paying a fund manager to sort of manage your money, and we see an emergence of more, I would say, more automated strategies. Yeah, automated strategies. And to talk a little bit more about how this new strategy, which used to be only for the rich long time ago, and for the very, very sophisticated investor, has now been democratized to the masses. Yeah? So a little bit more to talk about that would be Ami. Yeah? You will have a lot of insight into this shift in the trend. So what are your comments on that?
Okay, let me first start with the trend. When you want to buy unit trust today, basically you need to go to what you call financial advisor, basically a unit trust agent. You need to see him, and he will make recommendation what to buy, what to sell, and you have to give all this personal info, and you have to pay certain fee. Okay, because of that, the unit trust agent tend to serve only people with certain amount of capital to invest. Imagine you only have 1,000 ringgit to invest, and this unit trust agent will only make something like maximum 6.5%. He will not go to you because for him to travel to see you is not even pay for the cost of transportation. So this how actually our company started Robo-Advisor to serve for everybody. Okay, Robo-Advisor actually started in 2008 for a company called Betterment. Betterment, why they started, they always say that because investors are so confused. Can you imagine that in Malaysian market today, if you go to one fund houses, they at least have 100 funds. I work with 2 fund houses. Each these houses has more than 100 funds. So for you to choose few fund out of 100 is very difficult. It's very confusing. That's why Robo-Advisor come into place. In our company, we only have 3 funds only, basically. 3 funds only. But these 3 funds, you can actually have 231 portfolio. Just missing all of this fund. This fund we call growth portfolio. Growth portfolio basically invest in equity. Then income portfolio basically invest in bond. And lastly, we call it inflation hedge portfolio. Inflation, say, invest in asset that actually correlated with inflation, such as property, real estate, commodity, and more definitely gold. Gold asset. And why is Robo-Advisor can serve anyone? It's very simple. Because for you to invest in Robo-Advisor, all you need is just smartphone, download it an app, or you go to website, everything from KYC, deposit, want to withdraw money, then you can see your own statement all within the app. You no need to go to see a human. You no need to go to see financial advisor. You no need to go to counter. You no need to queue. These are actually the best part of Robo-Advisor. Then our Robo-Advisor is, as you all know, we only invest in ETF, exchange traded fund. I think Kamal will speak more about exchange traded fund. But if you can see that our algorithm actually can work with any other asset class. The only 2 reasons we actually buy ETF, and this ETF that we buy only listed in US for 2 reasons only. One is liquidity, because ETF listed in US highly liquid. Second is the cost. Cost to buy ETF is so bloody damn cheap. Very, very cheap. Imagine you invest 100 ringgit. If you invest, you have to pay fund manager as what you call management fee to pay my salary, Kamal's salary, Farid's salary, and this minimum fee that you have to pay every year. And normal unit trust basically in Malaysian market is very standard. Unit trust that invest in Malaysian market, you will be charged 1.5% and 1.8% that unit trust that invest in Malaysian market. But for ETF, instead in US, we have ETF for 100 ringgit you invest, they only charge you 3 cents, 0.03 cents. That's the only reason you see that. That's basically what Robo-Advisor do. The rest of process from buying, selling ETF, all done automatically into the system without human intervention, allocation, everything inside the system. So I the only fund manager inside the office.
So you're saying that the shift is driven by 2 things. Number one is simplicity, yeah? And the second one is the cost. And the cost is so cheap, and that the reason for that cost of investing through Robo-Advisor is because of the usage of ETFs, right?
Yes.
So let's talk a little bit on what ETFs are about. I mean, Kamal, you will have to step in over here and tell the audience what is ETF.
Yeah, I think just before going into that, I think just a continuation of what Ami said. So basically, I think both the Robo-Advisory ETF and the users are basically building the ecosystem that actually works, something like Airbnb, where it has the platform as well as the host, which is us, the ETF issuer, as well as the client. So I think in a way it's similar to that. And going back into ETF, another analogy that I would like to use, imagine yourself, imagine today is the 18th of March 2020, and the government just announced that they are going to implement the MCO. And then suddenly you have some money that you decided to invest in the stock market. But then if you look at the stock market, Malaysia, we have like about 900 stocks, 900 counters to choose from. But then you decided it's better if I can just follow the market, which is in this case the FBM-KLCI. So what you do is you try to buy into every single constituent of the FBM-KLCI, which is the 30 with the top 30 stocks. And then you try to mimic in terms of the weight. But then the problem that arises with this is basically two things. First is the high investment outlay that is required to buy the stocks, and at the same time the transaction cost will actually eat up into your performance. So this is where the ETF comes in. So ETF is basically an instrument that tries to replicate the underlying index, in this case the FBM-KLCI, for example, and try to solve the issue of higher costs. ETF is low. Is low in terms of the cost. So I think that's why the ETF will wrap up all these 30 constituents into one single product, and then it sell to you at as low as probably 100 to 100 ringgit. So yeah, that's where the ETF comes from. From the traditional sense, ETF started in the 1993. With the spider. The S&P 500, and then it actually take about a decade before it became more mainstream. So I think the same challenges that we are seeing in Malaysia today. And just to add up on what Ami mentioned just now, the fact that the US market in terms of the ETF is very cheap is because size does matter in ETF. So in order for ETF to have ETF is measured on two things. Basically, one is the tracking error, and another thing is the fee. So in order to reduce the fee, you have to have the scale. And in order to reach that scale, you need very high participation from all the market players.
So to recap, so an ETF is essentially the analogy they use is that someone buying a little bit of everything, right? But in one go.
Yes.
Right? Yeah. So in one simple and cheap bundle, they're able to get exposure to all the constituents of the index that they want to.
So in a way, you already got the diversification benefit that you are seeking.
Okay, and Chua.
Yeah.
So as a hedge fund manager, it sounds like your area of, as I mentioned, is a bit more active compared to the two gentlemen here. Would you agree or would you disagree with that?
Oh, actually, if you talk about hedge fund, there's a lot of strategy. So a lot of different kind of strategy of hedge fund. But for my hedge fund, I wouldn't say it's an active management.
Okay.
Yeah, why do I say so? Because we involve in futures contract, number one. Number two, we can long and we can short. So, and in terms of clientele base, we only deal with accredited investor. So basically, I know each one of my investor. So we know their background, we know their financial standings, we know what suits to them. So, and then we will actually advise how much of your wealth should put into this hedge fund because it's an alternative investment. You know that you shouldn't put everything into an alternative investment. Alternative investment is good for diversification. So what kind of diversification we are talking about? Long short strategy is a diversification strategy. You don't only long, you don't actually just hope price will go up because when there's a downtrend, you get it. And then there's another diversification in terms of asset classes. So for my fund, we have 40 futures contracts. So we have equity index all over the world. We play Turkey, we play Korea, we have Thailand. So that's diversification in terms of geographically. And asset classes, we have bond futures contract. And then it's a European bond, Canadian bond. So this kind of diversification is in terms of asset, right? So therefore, when we look at a client, it's like we look at the background of it, we recommend, and then when we do asset allocation, it's actually we call ourselves a structural program trading. So we back test a lot of futures contract, and then we choose what is suitable to us, So a lot of, as compared to some, when you actually invest in something, some look at expected return. But we started from a point of view of what is the expected losses. So we go actually from there. We always think that if the process is correct, the return is given. So we will not go and chase for return. We just make sure that the risk is there. Right? So that's why there's a bit of different in terms of asset classes, strategy, and the target client that we have. And of course, we acknowledge that investment now is come with a cost, right? And we acknowledge that we need to align our interests with the investor. So therefore, we are thinking is like, okay, so since we are hedge fund, we should have confidence on our performance. That's why for our fund, we do not charge any management fees. We only charge on performance fees. So in a way, it's like you make, we have a cut. You don't charge a single cent. That's alignment number one. Number two, majority of our wealth is in this fund as well. So actually we are in the same boat. So that's the difference between this kind of customized investment strategy as compared to others.
Okay, so Chua, so there are a lot of terms in there which could be new to some of our audience. So number one is the usage of long and short. So long means that you buy the asset and at the same time you also sell certain assets.
And a long short strategy is like that. Traditionally making money is buy low, sell high. Yes, you long it, you buy, and you sell later. So if you reverse it, it's sell high, buy low. So short is you sell high and buy low later. So futures contract is easy to do that. You can easily long and you can easily short. So for example, today if I take Turkey index or maybe CPO futures, I think CPO price will go down, I'll short it. So for us, we don't take a view. If you take a view, we are active manager. How do you don't take a view? Because our program will actually trace momentum. We need momentum to make money. So when we see a certain trend that, I think that now is a long trend, I'll enter. Right? But when we enter, we already think of where is the cut loss point. Our system will calculate it. So if we enter and the trend do not materialize, we have losses there. Right? But if the trend materialize, we just ride on it. So therefore, we always tweak what usually people do it wrong in investment. What people always do it wrong is like they take profit too fast. They let the losses run. So we tweak it around is like we take losses very fast and we let the profit run. So over a long run, you are fine. So we did a back test on our strategy on it. And once we detect that, okay, this futures contract, we can use our strategy on it. So it will be turned into a program where execution is automatically algorithm, right? So anything you touch, you just execute. So therefore, in our team, like I say, we have 3 founders, including me, it's 4 founders. And we have another guy doing an algo stuff. We have another guy coming in November. So the team is not big, but we handle 40 futures contracts around the world and around the clock, 23 hours. So how do we do that? Without algo, we can't do that, right? So that's why I would say is that, we are not active management. We are passive. Otherwise, we cannot handle it.
Understood. So there is more concepts you brought in besides long and short, which is you said earlier on that hedge fund is part of an alternative investment.
Yeah.
So what is an alternative investment? Is that it is anything that lies outside that of an equity, cash, or fixed income. So those are traditional asset classes. Hedge funds fall into the category of alternative investment alongside other things like private equity and real estate. Even real estate falls under the realm of alternative investment. All right, so that's a little bit on what the products, or the sort of strategies that the three panelists talk about. But let's talk a little bit also about a little bit more a personal question. Yeah, what exactly do you do on a day-to-day basis? Like, describe a typical day. Yeah, because
You can't say we do nothing, right?
a lot of people when they think passive, there's a lot of usage of just feed it into an algo, just tell the computer. Then what does a human do day to day? So maybe you can shed some light there into what exactly a day is like in the life of a robot.
Okay, to be honest, you saw Robo-Advisor, you think that, Robo-Advisor will do, the machine will do all the job for us. But I always have hard day almost every day. Okay. There's a lot more thing that we need to be done. You look at this, our Robo-Advisor work based on several. First is work based on theory. Then you work based on momentum. Then another part also it work based on variation. And we have another system called AI Assist. All these systems have to be monitored every day. All these systems have to be enhanced. All the time you have to be enhanced. If not, your computers will catching up with you. So every day what I do, actually I crunching a lot of number. I do a lot of spreadsheet. You know that I was from Active Fund Managers before. In the Active Fund Manager, when I do spreadsheet, the next thing I will do, I will make it more visual and publish it in the report. But in this Robo-Advisor environment, I do slightly different thing. I actually create spreadsheet, run a lot of data, write a lot of formula, but this spreadsheet actually I handed over to developer, programmer, and this programmer will input into the system. So system, and they will run it as a machine. So all the time you have to review. All the time you have to review a potential ETF. For example, in the world today, globally, we have more than 7,000 ETFs. For now, for time being, we have only 59 ETF inside our universe. 59. So our algorithm continue to screen, but human screen also matters. Because basically new ETF is coming up also, we need to trace them and include into our universe. Because basically how our machine works like this. We already have 59 ETF and our machine will at least choose 25 ETF and divided into 3 different portfolio without fail. And at night they have to do the trade they own. So basically everything have to be done flawlessly. So allocation has to be done right enough. And we have a lot of scenario also. There's a lot of scenario because market keep changing. It could not be covered by our algorithm. So every day I have to review my algorithm and every day I try to make improvement to that algorithm. Basically, if I make improvement, I put it inside my spreadsheet, inside my formula because I'm not a programmer, and I hand it over to programmer to put into the system.
Okay. So you can talk a little bit about that. When you talk about crunching a lot of numbers, what kind of what exactly are you calculating?
Okay, basically our algorithm is based on what we call correlation between ETF. You study CFA, you can see that the best way to reduce portfolio risk is to buy asset that aren't correlated to each other. You mean it's one may move randomly. It's not that one move up, another one have to move up. It's one move up, another one move down is negatively correlated. But you have to find 2 assets or 3 assets or 25 assets that relatively uncorrelated to each other. So basically, based on this criteria, we need to put ETF with very long track record. Basically, at least have 10 years of historical data. So that's one part we need to put into spreadsheet, and we will monitor the variance, basically the risk, standard deviation and variance, and all this correlation against all asset class. There's a lot of data.
That is minute by minute or daily data?
Basically, Robo-Advisor, our proposition is long term.
Okay.
Basically, you put all daily data. We weekly data, but our focus is more on monthly data. I think monthly is more matters for investors who invest long term. Our focus is long term strategy. We don't actually encourage investors to go in and out within this week or 1 year or 2 years. We expect investors to invest at least minimum 3 years.
3 years. That is the time horizon. So what you're saying, I mean, is that underlying the Robo-Advisor is the theory of the MPT, they call it, right?
Yes.
Modern portfolio theory, right? And that's what the CFA teaches you under the topic of portfolio management or in level 3. That's what the CFA is all about. It's about how do you manage, manage according to an investor's risk and return objectives.
Yes.
And the core of the MPT is exactly that, right? Diversification, because that is the only free lunch.
Yes.
You can get higher return with lower risk. So that is the core of the CFA, truly. Now, Kamal, like we talk about ETFs, for example. We talk about ETFs, and as Amin said earlier on, there's 7,000. How many ETFs are there again?
More than 7,000.
More than 7,000. There's thousands of ETFs out there. How do you differentiate between one ETF and the other?
I think for us, I mean, one of the reasons where we entered into the Malaysian market, I think VP Asset Management is still new in the Malaysian investment scene. I mean, we got our license in 2018, and we aim to launch an ETF as soon as early next year. So I think in terms of the strategy of launching this ETF is basically first we need to see we're not seeking to aggressively launch, but we are looking into the commercial viability of the product. This can be done by meeting and understanding the client's need, basically the institutional, be it GLICs or non-GLICs as well. So at the same time, when we look at the Malaysian market, we only have about 18 products for now. I think we saw potential growth in the ETF market in Malaysia, and especially in the Shariah space. That's where we are going into. So rather than trying to come up with all these fancy or exotic kind of ETF, we're trying to bridge and fill the gaps that is required by these clients. So yeah, I think that's how we approach the ETF in Malaysia.
So it is to fill that gap, and do you think that gap can be filled like with Robo-Advisors and increasing adoption of Robo-Advisors by the mass public?
Yeah, I think that's one of the I wouldn't say the fastest way, but it's the surest and gradual way to increase adoption of ETF within the Malaysian market. At least,
So Chua, how about on your side? How do you describe just a typical day in the life of a hedge fund manager?
I see. Okay. Because hedge fund is typically small setup. So basically, for my side, aside from doing reporting to the MAS, that will have our compliance to do that. A to Z, we have to do it. We have to onboard the client. I tell you the documents that you have to go through when you're doing the onboarding of a client. And then we have talked to client, onboarding. But I was fortunate that I was surrounded by a team of good partners. So we have a team like my partners, the founder, who basically day to day he do backtesting. So we started this one many years ago, 10, 12 years ago. But it was started with a manager account first. Then only 5-6 years ago we go to Singapore to open up this fund. So all this while he's doing the same thing. He's doing backtesting on all the futures contract, liquid futures contract all over the world. So that's why we are pushing our brokers to actually open up to let us play Brazilian market, all those where nobody. So he keep on doing that. And then of course, my part is on the daily execution. And we have to make sure that our execution and the backtest mimic. Yeah, if there is a discrepancy, then it's why? Why is it that there's a gap? Right? So that's what we have to do on a daily basis. And then that backtesting on current strategy. Of course, we also looking at some other strategies that we can actually adopt. We are actively doing a backtesting on that as well. So last time we do backtesting just purely using Excel. But now we have another programmer who do that in other forms. So my side is execution, and although it's automatic execution, we always have that one thing in mind. If let's say you let the machine to run it, if one day something happened or screw up, how fast can you take over the machine? And can you do that?
Understood.
Right. So even though machine is running, because machine run only like these 2-3 years, the automatic executions. So previously it's all by me and by another co-founder. So we do it day in, day out.
Previously you were manually key.
But of course still can, because our strategy is not too active. We are not go by minutes. But when markets move, we have to be faster. But 40 markets still can manage it. Of course, you got to be more effective or efficient. You have to rely on machine. But when you rely on machine, we always have one thing in mind, that I still always have to look at the markets. It's just that I don't need to execute, but I look at the markets. I must tell myself, if today something happens, I can take over it within seconds. Why? If I don't always look at it, something's happened, then I look at it, it's like, oh, what happened? What position do I have? So what position do we have is still always here. It's just that it take away your day to day. So we are algo, but we recognize that there might be some flaw there. So don't rely entirely on that. So this is what we do day to day. Of course, the onboarding of client is a lot of, not so much of like the CFA job already. It's really like talking to people, what kind of background is he have, what kind of product actually suits him, is our product suitable to him, otherwise don't. So we will always keep on doing that. And then after you onboard, you still have to maintain a relationship. So because office is small, I even have to wash the coffee machine.
So that's about 20 minutes
around there.
So everything I will go on it, but it's still quite fun because you're still doing a human job.
Actually, that's what I went way back in university. Econ. So there's this curve, so it goes like this. It's like a U. So on it's talking about unemployment and how much automation can take away. So the middle jobs will be taken away by automation. So all the clerical work, for example, all of that will be taken over by machines. But what will be left is only the two extremes. The very sophisticated jobs like programming, something that has to use creativity and ingenuity, and then the most basic jobs, like for example, washing, cleaning area and so on and so forth. So only the most menial jobs and the most sophisticated jobs. That's the only two jobs saved first. The rest all can be automated. Scary, huh? Scary. But right, just a little bit follow-up question on that. So Amir said that underlying his input into the Robo-Advisor is the modern portfolio theory and the underlying concepts. What about yourself? Like, what is the kind of input that you put into the algorithm?
The input of algorithm is, let's say, you make money either on momentum or reversal, right? So these two strategies, we're going to put it into the system and run it. But once, let's say, for example, crude oil is what we're playing. We say, okay, this crude oil, your strategy is okay, right? So you're going to use this. But at the same time, we have Brent, I have Shanghai oil. So all those correlationship is very high, right? So that's why we cluster it together. And then also using the correlationship to actually, at the end of the day, how much is to put to these asset classes. Not in terms of weightage, it's in terms of the weightage of how much your expected losses is. So we do not want to overexpose to a certain industry. But so that's why we have basically commodity based, which is like those cocoa, sugar, coffee, right? We have also like metal based, like the gold and silver, industrial metal, like the iron ore, equity indexes, bond indexes, and some forex index, some forex futures. So that's why the core relationship has to be balanced. Yeah. And then, of course, when you do that, the strategy itself has a negative correlationship with the overall equity markets. So that's because of the diversity that I just mentioned, strategy, long, short, all those. So you have a negative correlationship. So if you have negative correlationship, you know it's a free lunch. Yeah. But of course, alternative investment that serve the purpose, right? So we do not want to take over the mainstream of equity because that should be the way to do it in terms of investment. But alternative investment will actually, especially have a negative correlation, will actually make your portfolio more balanced. As in, my fund typically do very well during crisis. Because during crisis, usually correlation all goes to one. Yeah. So when it moves all crash, so especially when you can short, so it's actually really good market to go in at that time.
Great. So that's a fantastic point you brought up. So negative correlations, you're saying that when the equity markets go up, in a way your strategy goes down. But then when the equity markets go down, you go up. And that's where the hedging aspect comes in. Yeah?
Yes.
You're hedging your losses. When somebody makes losses, you're gaining, and vice versa, right?
Yeah.
That's great. Okay, maybe on to Kamal and Amin now. So both of you have sat on both sides of the active and passive divide. Yeah. So you spend a large amount of time in the active management, picking stocks, doing fundamental research, and now you are also on the other side of the fence where you are, talking a little bit more about usage of ETFs and so on and so forth. Now, what would you say is the biggest difference in skill set required on both sides?
Okay. As you all know, I joined this industry since 2002. Basically, I become on the fan of active management since 2002 all the way until 2019. 17 years. Okay. Basically, when you do active managers, there's a lot of things you need to do. Basically, active manager, you don't sit in the office that often. For example, I used to travel 10 days to Indonesia. 10 days in Indonesia, go to 18 cities just to see 30 companies, 40 companies, do site visit, meet the management, and try to gain the insight of the company. That's what active fund manager had to do. Then you came back to the office, you're crunching all the number, put all the number, trying to put the value of that companies. So there's a lot of work. Basically, active fund manager is a lot of work, and in active fund management environment, there's a huge team. For example, when I was fund managers, if I cover property sector for the longest time. So I have colleagues that cover plantation sector, I have colleagues that cover bank, oil and gas. Then when I become fund managers, I used to cover regional market. But I have some fund managers, some analysts that help me to cover certain markets. I used to cover Asia Pacific market. There's some analysts help me to cover Japan, Korea, Australia, and ASEAN market. Basically, active management, you require huge team. A lot of things they do the same thing but cover different things. And in terms of trading also, in active fund management, as fund manager, I just send out order, and the equity dealer will monitor my order. They will skip the order for me. Now, when I join into quantitative team, you mean passive investment, quantitative team, the investment team is only me. I have to do everything. So basically, 90% of things is done by the machine. And I always stay in the office. I no longer need to see companies, no longer need to enjoy. Sometimes you see the companies, you go vacation in the beach. I can no longer do that. Now I want to do vacation. I had to take my own leave, pay my own. Okay, that's the two side of story. But in terms of skill set, last time we need to go more qualitative. It means you need to understand the vision of the management. But in this side of the world, you need to be more quantitative,
I see.
more data-driven,
Mm.
rather than what you call judgmental. There's a huge differences between the two.
Kamal, what would you say? If you had to-
Most of it already covered by Amin.
Mm.
But probably I can just add up. I think in terms of the skill set, it's not really a skill, but then I think the willingness for you to, to learn new things, because I think that there's the difference between the passive and active management. So your willingness to learn new things, your willingness to be proven wrong, and your willingness to adapt to changes in the environment, I think is very key to be successful in this industry. I think that's pretty much it.
Okay. And then both Chua and Kamal, right? You have the CFA designation, right? So how do you feel that the CFA, has it played a role, any role at all, or a little bit? What is the degree of, I would say, benefit once you've gotten the CFA in this kind of industry?
Yeah.
You want to go first?
For me, the CFA is a result. I will always think back the process of having it. So the process actually make you become a person. Like, for example, if you today ask me to do something that I don't know, I will tell you that, oh, don't worry, give me some time. I will learn it, I'll know it, and I will excel it, right? So it gives you that kind of confidence, right? But CFA, of course, now that I already 40 something, so therefore, a lot of people tell you when they go into senior positions, they say, oh, CFA is okay, good to have, but nothing special, especially after you excel in it already. But I tend to not agree on that, because a lot of time, you have A, then you have B and C. If you don't have A, then talk about going B to C, right? So don't ever forget when you have C, you say A is not important at all. So I always remember, if not because of CFA, I will not get my first job in investment bank. If not because of CFA, I will not have a lot of advisory jobs opportunity. I will not have opportunity to know a lot of amazing people around me. Right? So that's the thing. Of course, at the end of the day, the knowledge is always very important. So the knowledge might be outdated if after so many years, I took my CFA like 20 over years. 20 over when I was 20 something. So of course, the knowledge keep on changing, but the CFA syllabus keep on updating. So it's updated, very new to it. So that's why if a lot of people ask me, oh, should I take CFA? I will tell them, yes, please take it. And just remember one thing, when you have CFAs, don't make it as something as, sometimes people when they have CFA, they thought that, oh, I have a good weapon. Then after that, they say, I thought that I passed CFA, I can actually go outside and demand something, demand what. So it's not. That's because you're too result driven. You thought that after you have CFA, you can do this. No. CFA will actually enhance the whole, your process of learning, how you do things. Then when you have it, please forget that you have it. Just do whatever things that your boss or whatever comes to you as you have no CFA. If you always tell that you have CFA, people will have expectation, oh, you have CFA, then you also cannot perform. No, that one is secondary. Once you have it, that is secondary, right? But when you are having it, please put all your efforts to go and get it. Right? So that's my advice to the young people. Now that I know.
I think that's the biggest misconception. Like they think that once they pass the exam, the employers will pay you for those 3 letters behind your name. But that's not true. What they're paying you for is for the output that you deliver, how much money you can bring in, what's the return that you can get, right? So the CFA equips you with the tools.
Yes.
But how skillful are you with utilizing those tools? That is a big, I would say, the bigger question. Yeah? So but without those tools, you can't even do it in the first place. So that's one great part. Okay, let's check if there's any questions right here on the Mentor Pulse. Do we have any questions on Mentor Pulse? Do we? Let me check, yeah. Okay, there's many questions actually. Come, let us try the first one. It's a bit too caught up in the conversation, if you know what I mean. Yeah. All right, how about this? The FBM KLCI consists of only 30 companies compared to the S&P 500, which consists of 500. Do you think passive management is more consistent for different regions? I think this will be a question for, I would say, Kamal. Yeah? Would you like to take this question? Do you think passive management is more consistent for regions with more companies in the index?
I think from the academics that we learn, normally diversification has the ceilings of how many stocks. I think usually they say about 20 to 30 stocks is basically the portfolio is considered diversified already. So yeah, I think that's pretty much summit. I mean, it doesn't matter if it has even 1,000 stocks in it, but then the maximum limit of diversification is, it already achieved when you reach about 20 to 30 stocks.
Maybe a follow-up question to that is that sometimes indices, the main criticism about using an index is that it is embedded inside the momentum factor. So momentum really drives the index. Yeah. So what would you say to that?
I think in some way there's some truth to it, because in a way that there's a survivorship bias when it comes to this indexes. These indexes. So the constituent of FBM KLCI now is totally different from 10 years ago, definitely. So I think there's, the bigger and better companies will always be in the index, whereas the one that loses out is basically thrown out from the index. So yeah, I think
that's the sort of feature.
Yeah, right? It's the survival of the fittest when it comes to these corporates.
You say it's a feature, not a bug.
Okay. I have no comment on that.
Come, let's go. Oh, this one is a very, very interesting question. I think perfect for Ami. How accurate are Robo-Advisors from time to time? In times of crisis, there are more variables to analyze, and as Chua said, correlations go towards one, where all assets are correlated. So people seem to prefer to go for a human advisor for solutions in time of crisis. So how much should they rely on Robo-Advisors?
Okay. Let me start with this. There's no such thing as a perfect system in this world. We need to continue to evolve. But one thing that sure about machine remove what we call human emotion. Emotion is very actually impair the performance of portfolio over time. For example, you can see what happened in this February. Nobody would expect market that going down so sharply and rebound so sharply. The only way to do that just to monitor what we call volatility. That's what we've been doing. Then there's another part that we have inside our system. We call it AI assist. In our system, we call it AI assist. AI assist is a system, a proprietary system, but we use external party to actually extract data from all social media, plus 700 blog to monitor sentiment in the market. Okay. When AI assist detect the sentiment market start growing to be negative, it start to act to remove certain ETF or certain component inside our portfolio to protect the downside risk. So that's something that actually human can never do. How human we can actually communicate 7,000 blog and all the message inside Twitter, Facebook, LinkedIn, and Instagram. That one part actually, what I say is that machine actually can cover a lot more ground compared to human. Even though machine is not flawless, but again, it's actually something that actually got something that can be better than human, and certain part human definitely better than the machine. But in the end, we need to look what is your preference. If you're still comfortable with active management with human, the market is still there for you. And for us, we now rely machine. Almost 99% of our decision is machine. The only thing that actually human decision is what we call investment committee, the board. every algorithm need to be approved in investment committee.
Understood. That is a safe and the safe checks to check whether it's going according to how it's supposed to be. Oh, this is
I got a question.
Yeah.
If let's say the AI detect that there's a crisis or coming, so you guys will actually turn into something more defensive, or your advisory, you advise your clients to actually turn into more defensive stuff.
Okay, basically, when client put money into our fund, basically everything is under our control. We need client don't get to decide what they want to buy, what they want to sell. Basically, our system we decide what we want to buy, what we sell. For example, during crisis, actually this year our AI has actually done 3 major adjustments. I think earlier month they did buy more gold one time, and I think in middle of May our AI actually detect to sell UK market.
I see.
And in July, they also our AIS decided to sell private market. Basically, our portfolio, our growth portfolio, the equity portfolio consists of ETF from different countries. We diversify across geography. So it's just like the system by Chua, across different geography. So when our AIS go through this social network or news or abroad, find this country is at the risk, they will automatically reduce the weightage in that country or totally remove it.
Can you guys go into reverse ETF?
No, we don't do futures. When you do option, we don't do leverage. You only buy asset with underlying.
All right, so we have 5 minutes left. One last question for the panel. This one I think is quite relevant. This obviously came from someone, I would say, looking to break into the asset management industry. So the question is asking, where should I start if I'm interested in asset management? Does it matter if I start in active or passive? Is it easy for me to make the switch between active to passive? Who would like to take this?
Okay, let me start first. I think few years back, actually, teachers undergrad student in one of the local university. First, you need to look at the resource of that university first, that you can learn about the market. Say, I've been teaching for few weeks now. Suddenly, I need to go to computer lab in that university. You know what I found out? That computer lab got Bloomberg. They have one terminal Bloomberg that nobody using it. Nobody using it. You know, Bloomberg is a standard, right? Bloomberg is standard. You pay standard pricing across the world. Bloomberg in university and Bloomberg that you use in your office is the same. So Bloomberg is a fundamental to all fund manager stuff. Without Bloomberg, there's no fund manager stuff. So you need to look at your university. Is there any resources that you can learn about the market? That's actually a big start. But for the second question, my opinion, better you start as active management, because active management you tend to learn a lot more things. Because you need to visit the company, you need to understand the language of the management. You need from the active management, so you start to learn the basic, how to do forecast, how to actually make qualitative decision. Because when you move into ETF, everything, you actually input data into the machine. It's not you are taking it. But time you actually learning. Now you have to learn and make machine learn from you also. That's why my opinion, you have to start from active management first. It's the best.
Yeah, I think probably I share the same view, but probably because probably a bit biased because I started from the active side as well. But I think apart from trying to go into active first, I think the first area that you should go into is the analysis part, because it's where you learn and improve your analytical skills as well. But at the same time, if you don't get to be in the analysis or active side of the asset management, don't feel bad about it. If you have to go into risk management, just go into it. And then at the same time try to take CFA. Then that's how you try to widen your knowledge, your knowledge base, and at the same time, I think you can always make a switch later on in life, and probably it is much better because you have a different angle of perspective that I mean when you get into the asset management from other industry as well. So,
Yeah.
All right. Okay. So I think that sort of wraps up the session for today. And please stay tuned for tomorrow, at 6 p.m. Same time, same place, on the topic of versatility of a CFA charter holder. All right. Okay. Thank you, everybody.
Thank you.
Really
Thank you.
enjoy the session.